Hey, Investing Unscripted listeners. If you want to earn 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/investing unscripted.
Hey friends, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, Jeff Santoro, he who is the voice of the people. Hey Jeff, it's good to, as usual, have you on. How are you?
You're having me on? I thought we were like on together.
Hey Jeff, it's good to, as usual, be on here with you.
There you go.
How you doing?
I'm great. How are you?
I'm good. I'm good. Man, I hope we don't edit that out. We have to leave that in.
No, we should leave it.
Good.
It's actually the perfect introduction considering what this episode is going to be.
Yes. So we're calling this episode Investing Unscripted, Unscripted.
Maybe this could be like a thing we do regularly or semi-regularly. I kind of like it. I mostly like it because it involved no planning.
Well, I don't know that I would say no planning. So all right. So caveat, let's expose the making of the sausage a little bit here. Our podcast is called Investing Unscripted, but we actually do a lot of planning and we don't script it out, but we do typically have a pretty toit outline of topics and, the things that we're going to kind of go through and the things that we want to make sure we talk about. But this is actually, we have some things that we talk a lot, and there's different things that we talk about and topics that come up just in our lives that never see the light of day in terms of a podcast episode or videos or any of the other content that we make. And sometimes different little bits and pieces of that actually are interesting. And we have a lot of those things that we've been talking about recently. So we're going to actually talk through some of them here today, and we're going to let the conversation kind of go where it goes.
Yeah, we typically have an outline mostly to keep Jason from going off on 7-minute long tangents, but
Kind of like I just did to start this episode.
yeah, thank you for so wonderfully demonstrating it. But the most fun we have,
We scripted that part.
the most fun we have honestly sometimes is when we're on this platform that we use to record to plan the show and we start to just go off on a tangent with one another. So we're going to try to recreate some magic here. But yeah, it is not scripted in any way. We have just a couple topics, but neither of us have really prepared for them. And they're mostly things I know nothing about. So it'll be like our normal conversations.
There you go. Yeah, I'm glad you said it because I was going to. We could almost call these like our hot mic episodes where we're saying things that maybe we wouldn't normally necessarily say with the mic turned on, but not like in that way, not in the way that maybe some famous people have had hot mic
Right.
episode.
Yeah. We don't want to get
episodes.
canceled with our hot mics.
Yeah. No. So here's where I want to start. So I've got our little list of things here, and I'm going to pull kind of from the middle of it because I think one of the things that I enjoy that we talk about is not necessarily vibes in this case, but just everything that's going on with the market, how it's been really kind of an odd year. Every year is odd in its own way, but I really just want to kind of talk a little bit about, everything that's going on with interest rates, and the market seems, as always, the market's looking forward and reacting to what it expects is going to happen. And it certainly feels like that's the case with interest rates right now.
But it's weird. It's like, here's what I don't get. The market's forward looking and the market doesn't like uncertainty and the market doesn't like when the conventional wisdom turns out to be not true, right? Would you say all those statements are fair?
Yeah, absolutely. Yeah. Yeah.
But this has been, and this is why this year's been weird. It's been a whole year of the thing we all expected that was going to happen just keeps being pushed off, right? The year starts and either I forget exactly when this sort of entered the zeitgeist, but basically for this whole year, people have been anticipating rate cuts.
Bro, no,
And
this goes back to last year. They were
okay,
talking
fine.
about rate cuts
Even still,
last summer. They were talking about rate cuts last fall.
Right. So regardless, this year has been dominated in my mind by when will we get this rate cut? And then whatever the inflation and jobs data is, sort of the pendulum will swing a little bit closer towards getting them sooner or towards getting them later. Now it feels like after the last couple reports that it's basically inevitable is what it sounds like from what I'm hearing, that we'll get one in September. And despite all that, notwithstanding last Monday and Tuesday and the Thursday and Friday before that, the market's just been ripping. It feels like the end of 23 when we had those 2 months of craziness and or all of 2021. And it's just when there's been so much uncertainty and so many things being delayed that were expected, I'm just surprised. Like
Yeah.
if you had told me these news events and then said predict the market, I would have said down or flat or very volatile, right? Like up 5, down 5, up 5, down 5. And it's just been up and to the right. It's been remarkable.
So a couple things. I'll talk more about interest rates and things that I've said in the past about interest rates and my thoughts on it. But first, I just want to give some market data. So we're recording this on August the 20th. The market's basically closed. It's not going to move enough to really change these numbers that much. So August 20th, we've basically got a week left in the month. So we hit Labor Day holiday. So things are going to be a little calmer for a few days there before we actually get to the very last day of the month. But the point is that we're essentially about a week's worth of trading days from being 2/3 of the way done with the year. Historically, the market, we've talked about it before, usually generates an average of 10% in annualized gains a year. We never have an average year. It's exceptionally rare. Like it's less than 1% of years have actually ever actually been up 10% or within, rounding up or down to 10%. The Dow is up 9.8% so far, 2/3 of the way through the year. The S&P 500's up 18.6%. It's actually outperforming the NASDAQ 100, which is up 18%. So it's been a great year. Now, I think generally the economic results, like the financial results of most of the companies that move the needle, like look at the earnings of the biggest companies. They've had great years, right? They're making a ton of money. They've earned more money than they did a year ago. Microsoft, Meta Systems, Alphabet, like all of them. I mean, they're doing really, really well. Apple maybe is the one.
Well, and it's not, I know they're the ones that move the market because they constitute such a large percentage of it, but it's been the rest of the market too. Like I'm not looking at the data
Yeah,
of what the
yeah.
non-Mag 7 have doing, but just thinking about my portfolio and Q2 results, because I believe all but one or two companies that I own have reported at this point. I can count on less than 5 fingers the amount of companies that I would say put up a bad quarter.
Right.
What the stock did in relation to it, different story. But so yeah, there's that economic strength and strong business results goes beyond just those big companies.
So I want to look at the just the S&P 500 just to kind of clear up the chart a little bit. But back in the spring, the S&P fell. We had about a 5% sell off. And then this more recent sell off was only about 7 or 8%. We look over the past year and last fall from late July, the highs through, I don't know, when was it? November through the low, same thing, about a 9% sell off. So over the past year, we haven't had a correction. Now, of course, the caveat there is that we had a pretty protracted bear market in 2022
Yeah.
that reversed in late 2022, and we've seen great gains since that bottom. Really, like January 2023, like since then, we've seen just the market has really ripped since then. The interest rate thing, I want to kind of circle back around to that because like that's the big thing that the market is betting on right now, that large investors are betting on, is that the rates are going to get cut. That's going to provide ballast for stock valuations. That's also going to help companies that need to refinance, cost of capital, all that stuff. And that the idea is that it should ballast the economy, if not necessarily stimulate it. Some people think, interest like what's a 25 basis cut going to do? It's not going to, doesn't matter. People don't think about interest rates. Well, that's bullshit. If you're refinancing or you're buying a car or a big ticket item,
Yeah, 25
those
basis points on a mortgage is a decent amount of money.
it's a lot of money, right? It is. It's a lot of money. So I think that's the bigger thing is it's the round numbers that people are looking at. that it could help. But this is the thing that I've been consistent on. And maybe it's because I'm old enough that I've been through enough rate cycles and watched what the Fed does. What they always say is positive things that the market wants to hear. They always say things that the market wants to hear because they know their words move the market.
Hmm.
But what they do is what they think is most important to stimulate the economy and the jobs market. That's the bottom line, is they say the things they want that investors want to hear. They do the things that the market wants to eat. So they tell us, here's your strawberry shortcake while they're in the kitchen cooking up Brussels sprouts,
Right.
right? And I've consistently said that the Fed is not going to start using its only significant tool to support the economy, which is cutting interest rates in a healthy economy. They're not going to do it. And they haven't done it. We're hearing that it's probably more likely that in September we are going to get that 25 basis point cut. What have we also seen? We've seen a lot of industries that require a lot of debt for consumers, not just businesses, but for consumers, has gotten eviscerated. Look at the EV market. It's been eviscerated. Interest rates went up. Look at residential solar.
Hmm.
It's gotten eviscerated. Interest rates went up. There's a direct correlation behind those. It's not the only reason for both of the other. There are other factors that have come into play, but the reality is the Fed's starting to respond based on seeing some weakness in some segments of the economy that they want to get ahead of before we actually go into like a substantial, significant recession.
Yeah, and we're not gonna doesn't seem like we're gonna get any, substantial amount of rate cuts. Like, we're not going back to near 0%, because like you said, that is their basic their only tool really that they need to reserve it for if we do hit a downturn, right? Like, interest rates went low during COVID, or lower during COVID, because they needed to stimulate the economy. So it's like we're gonna go back to 1% in the next year, I don't think.
Yeah.
I just think the thing I
Mhm.
keep two things I've been thinking about as it pertains to interest rates. One is, in the 4 years that I've been paying very close attention to all this stuff, I went from not paying any attention to that kind of stuff, mostly out of ignorance, to paying a lot of attention because I became interested, learned a lot more, and we have a podcast. And now I'm almost like finding myself heading back towards like, okay, I'm just going to stop paying attention to it anymore, because largely it doesn't impact how I think about investing. But I am still interested in how it could impact the result of the businesses that I follow. And the other thing that I keep wondering is, as I said when we started, the the stock market seems to be doing the opposite of what I would have expected. So what I'm curious to see is, let's say we do get a rate cut in September, and maybe, who knows, maybe we get another one in December. Do we then see a downturn? Like,
Yeah.
the the
Right.
market's been so resilient with higher for longer interest rates. Like, it would just be funny to me, and ironic, I guess, if we finally get that rate cut in September, and then, by December or early in 2025, we are in a downturn again, like we saw in 2022. I think the other thing that I'm curious for your thoughts on is, do you think we saw as much of the crappy businesses that came public in 21 that probably shouldn't have? Do you feel like we saw enough of them get shaken out of the market by the higher interest rates, or are you surprised at the resilience that weaker companies have been able to demonstrate over the past year and a half, and kind of keeping themselves around?
No, because I think that cycle just takes longer than
Yeah, because a lot of that
maybe
debt hasn't rolled
expected.
over yet.
I mean, that's it, and a couple things. So number one, we're in this place in life with technology where things can happen really, really rapidly, but those things aren't always necessarily like the virtual things,
Mm.
right? So, they aren't the tangible things; they're the virtual things that can happen really quickly. Like NVIDIA, for example, their revenues absolutely exploded. Um, but they had already developed the technology; the infrastructure was already in place to manufacture the chips. The capacity was available at TSMC because of weakness in other parts of the semiconductor industry, right? So it that happened really, really fast. They're also charging a really high premium. So like the actual volume of production wasn't some massive scale up of output, you know? So that's just like one example of where we saw this massive explosion of business. Thinking about other companies, think about Meta Platforms as rapid growth, you know, to $1 billion to 5 billion to 10 billion. It's all virtual, right? It's all happening on the internet. So it's not, building factories. And then think about Tesla as successful as Tesla has been, they've always taken longer by far than Musk said that they would. Even hitting pretty aggressive goals, they always took a lot longer just because it takes longer to do stuff in the real world. So again, you talk about things like debt rolling over. A lot of those companies built out debt profiles that are relatively well laddered. So they're only just now. It's less companies. I think the biggest thing too is that like my expectation for a lot of that is less companies failing or having to be acquired because we have seen a ton of startups get acquired.
Mhm.
STEM is one that went public as a SPAC that I put it in the portfolio contest as one of my kind of bottom feeding, this company's going to bounce back companies, but they're in a lot of financial trouble right now and they could get gobbled up pretty quickly. Tellurian is about to be acquired for $1 a share, and it took the company 5 or 6 years to get to this point. And part of it was cost of capital going up, not because of its existing debt, but because now we can't raise debt, right? Its access to capital was limited. But I think what we're gonna see is a lot of companies that benefited on the bottom line and got really great profit over the prior decade to 15 years, their profits are gonna get squeezed going forward, and they're still trading at really, really high multiples. So a lot of the impact a lot of investors are gonna feel and maybe not even realize that they're feeling it is watching these stocks underperform as they refinance at higher interest rates and their cost of capital takes out of their margin because their operating expense goes up, their operating margin gets shrunk. Even though maybe their gross margins stay high and they still are selling at a pretty good clip, growing revenue a little bit, your interest expense goes up. The money's got to come out of somewhere, and it comes out of the bottom line.
Yeah. I wasn't even thinking about that part of it. I was yeah, I
I
mean, the
think the
question I
implications there are bigger for investors than companies that end up having to get acquired because they took on debt and they can't afford that debt anymore.
and it puts investors when those kinds of things happen, I think it puts investors in a sticky spot because you look at the let's use the scenario you just laid out, right? Company that you have been following, you own, you have high conviction in, it's a good business. All of a sudden, down the road, you start hitting some quarters where there's, margin compression, and they're saying things on the call like the business fundamentals are fine. This is related to rolling over debt at a higher interest rate, and that's going to impact us in the short term. And you say to yourself, like, okay, that's like a normal thing that happens when interest rates go up and the business is humming along. Otherwise, I'm going to hang on. And that's probably the right decision in the long term. But if if you bought that company trading at 40 times earnings, you know, it's it's priced for not having to deal with that. And I think that's where you get jammed up as an investor because you have these two things you're looking at simultaneously. One is a business that is ultimately performing well and also a stock that's down 30-40%. And you're saying to yourself, I don't get it. And I think a lot of impatient investors end up selling.
Yeah.
And it's just that it's not that the business was flawed in any way. It's just that you happen to buy it at the wrong price. So I think that's the hard thing that that's going to be kind of interesting to watch over the next couple years, I think.
I can give you an example. NextEra Energy Partners dividend yield is still incredibly high. The management has been steadfast that they're going to be able to keep paying their dividend and even continuing to grow it. They were refinancing debt in the twos and low threes a couple of years ago. One of their more recent tranches of debt, 7.25%.
Mhm.
That's gonna really start weighing on a lot of these businesses that rely heavily on debt.
And
So,
and by the way, if we get a 25 basis point rate cut in September and you refinance that to 7, that's still high. It's
yeah,
like not like it was.
right. No, that's the key. That's exactly the key. So a lot of companies, they weren't prepared for because corporate debt, I've talked about it before. I wanna highlight this because I think it's really important. It's not like a car loan or your mortgage on your property. Corporate debt is interest-only debt almost every time. You're very rarely amortizing, you're just paying interest, and at the end of the term, you refinance, you just roll the debt over and you do it again. So, that's what's happening.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. So this is maybe a easy segue into another topic we had on our little list of things to talk about here, which is dividend stocks and thinking about them versus or in comparison to quote unquote growth stocks. Because I do wonder, I've been thinking a lot more about dividend stocks lately. We just did an episode about that. I don't have a lot of dividend stocks in my portfolio, in my stock portfolio. I do have a lot of dividend paying ETFs in my overall investment portfolio. And I think it's funny, like, when I was a new investor, I was excited and I wanted the high growth shiny thing. And also when I had such little capital invested in individual stocks, like even a company with a really high dividend yield was paying me $1.30 a quarter, like because I had such a small position. And now that I have a couple dividend stocks that are more sizable, and I'm starting to see double digit quarterly dividend payments, I'm starting to realize like, oh, I actually I do see how over time with enough money put into dividend stocks, like this could end up being a substantial income driver, in retirement and things like that. So tying it back to interest rates, do you think there's any plus or upside or downside to dividend stocks when we see the interest rate drop?
Yeah, so here's in theory, here's how it works, and historically, this is generally true. Bonds and other fixed income investments, you own them for the yield. Generally, you also own them for the stability of the value of the bond itself. If you buy a bond and you invest $1,000 in a bond, a 5-year bond that pays 5%, that $1,000 is gonna pay you, what is that, $50 a year? You're gonna get your 50 bucks a year, every year for 5 years, maybe every 6 months, however they pay it out, depending on the bond. And then at the end of the 5 years, the bond's gonna mature. When it matures, you redeem it, you get your $1,000 back, right? Now, along the way, as interest rates go up and down from the day that bond was issued, if you bought it as a new issue and you paid the face value, the $1,000, as interest rates go up, the value of that bond's gonna go down because you have to, if you wanted to sell it to somebody, you'd have to match the going rate, which means you'd have to discount the bond for the yield that they paid to buy that bond from you would match the going rate. If interest rates go down, the value of the bond would go up because if you sold it, you could sell that bond at a higher premium because, again, you're matching the going rate. When somebody's buying the bond, they're basically buying the yield. That's if you're buying a bond in a stable business and it's highly safe. It's very, very
Right. It's
stable.
not going to, they're not going to default.
investment grade, right? It's an investment grade bond. When you start moving into some of the junk categories where it's maybe there's a higher chance of default on the secondary, you're going to get a higher interest rate, number one. And sometimes on the secondary market, the bond can get discounted even more if the company is like at substantial risk of filing for bankruptcy or something like that, where you may have to go to the front or the back of the line depending on what you owned to actually get your money back, right? So those factors kind of come into play with bonds. It's clear when interest rates go down, the value of the bond goes up, right? If you wanted to sell it on the market right then, the yield that you get won't change because you have a contract, you have an agreement, because you own the debt, and the agreements they're going to pay whatever they're going to pay on that debt, right? So the way it historically has worked is that when interest rates were high and yields were high on debt, valuations for dividend stocks get pushed down because in some more or less amount, dividend stocks do compete with bonds. Investors that are looking for income are going to look at both, right? To some degree or less. So interest rates move up, valuations get pushed down, so the yield gets pushed up on dividend stocks. The inverse is typically true too. You've seen that over the past 15 years where yields on dividend stocks have been just excessively low on the S&P 500 by and large has paid some of the lower yields over the past 12 or 15 years than it has historically. So that's because you weren't really having to compete with bonds in the ultra low interest rate environment that we were in. So valuations went up because investors took on more risk investing in stocks to try to capture some return, right? Whatever yield you can get plus the value of the stocks going up, that capital appreciation. So on paper, the math is that if dividends go down or if interest rates go down, valuations should adjust up a little bit for dividend stocks. We'll see. We'll see what happens. I mean, I can tell you this: you look broadly at a lot, especially higher yield stocks. REITs went down for a lot of other reasons because of worries about commercial real estate. But we've certainly seen as interest rates shot up, valuations did get pushed down and dividend yields did get pushed up on some stocks, not all. There's plenty of dividend stocks that are still trading near all-time highs.
Yeah. Here's another thing I wonder, and I could be wrong about this, and if I am, I'm sure you'll tell me because you take pleasure in that. So,
Hey, Jeff, you're wrong.
thanks, man. One of the arguments I've heard in favor of dividend stocks is that a company that pays a dividend has to be more fiscally responsible, right? Because if they're paying out 20 or 30% of their earnings in a dividend, they have to make sure they have that cash on the side. They can't invest it in anything else because they're paying that dividend.
Yep.
So by that logic, I would think a company that pays a dividend is less likely to be in the position of really struggling to keep things rolling with higher interest rates. Do you follow what I'm saying? Like a young speculative company that, you know, like came public when they shouldn't have in 2021 is not the same company that's paying a dividend usually. So do you
Right.
think do you
Right.
think in a world where
In a
we
world.
in a world where we might still see a couple years from now some companies like we were talking about earlier really suffer from interest rates, like let's say they get cut but still not back to where they were.
Right.
Do you think dividend companies, because of the fact that they have to have a little bit more financial discipline, stand to benefit? Does that make sense?
It does. It's as usual, the reality is more complicated than the answer I'm gonna give, but the answer I wanna give, I think, kind of lays out the implications and explains why historically dividend companies that pay dividends and generally have a track record of growing the dividend, maybe not every year like, like dividend aristocrats or kings do, but like they generally grow it most years. Why those companies generally have been market beating investments. It starts with the fact that a company that pays a dividend didn't start that way. They started paying the dividend when they got pretty big and they had like some pretty good competitive advantages, maybe their scale, pricing power, brand power, all that kind of stuff. And they were making more money than they needed to fund their growth, right? So they had extra money, right? And all of the competitive advantages that come along with it. So number one, like the biggest reason why these dividend stocks and dividend growers beat the market is just they're the best companies.
Yeah.
That's that simple. They're just the best companies. Where the paying the dividends kind of comes in is that managers are people and people suck at capital allocation. The reason, Jeff, that most investors underperform benchmarks is because they're bad at investing. We're not wired to be good at investing. And to expect that the CEO of any company is going to be a great capital allocator, I think is a mistake, unless they have like a really proven track record of being good at doing that kind of stuff, like Constellation Software, for example. They're really good at buying software companies for cheap, integrating them, and getting more profit out of those businesses when they integrate them. Salesforce.com has been a really good acquirer. I mean, I don't even have to bring up Buffett, but like those people are really, really rare. The winning companies are the companies that are just really good at what they do, and they have really good people running those companies that generally are really good at whatever that company's business is. They're rarely good at actually allocating money. So so the odds are better when they give some of that back to you
Yeah.
and let you screw up with it, but then it gets to count in the total return, right? That the business is gonna outperform. And the ones that have a track record of generally growing the dividend, it demonstrates that those businesses are still growing, right? Hence making them generally better businesses to own. But there's no doubt about it that it's getting that money out of the hands of management when they're gonna go do something dumb with it. Like, maybe it's a bagel company and they decide that they're gonna, I don't know, buy a coffee company too, because, well, coffee goes good with bagels, right? So we could run a coffee business, even though the coffee companies they're buying are all in the same markets and they pay too much for it. And now they have all this extra operations costs, and then they have to figure out what to do with that operations cost. And they don't really gain extra business. And there was something really nichey and special about that coffee company that they bought that then they screw that up and the sales don't grow. Right. So it's when they try to do something that's really not what they're good at doing, which generally is just allocating capital outside of the industries that they know, that they screw it up.
Yeah.
Companies are usually bad at buying back their own stock too. But if they're buying it back all the time and they're dollar cost averaging with their share buyback program, it's going to work out because they're repurchasing when it's cheap and when it's expensive. So I guess the best way to think about it is like they kind of solve a lot of the problems of finding good companies for you already because you're fishing in a pond of really, really delicious fish.
Yeah. It sounds like you're saying that yes, they might be better off than a non-dividend paying company in a higher for longer interest rate environment, but it's not necessarily because of any other reason and they're just a better business anyway?
Exactly. You're just starting off with a really good
Yeah.
business and it's a profitable business. That means that it's a good business and it's profitable. They probably don't need external capital. They don't need to borrow money. But if they do need to borrow money, they probably are getting more competitive rates because they're a really good profitable business, right? So they're viewed as a safe borrower.
So speaking of management teams and capital allocation and whether they're good or bad at it, let's talk about Boston Omaha.
They're bad at it. Next topic.
All right, next topic. Here we go. Moving on. Well, it's funny you say that. Like, yes, track record wise, more bad than good. But now that they're out of the asset management business, it feels like there's less capital allocation decisions to make almost, if that makes any sense. Like it's just going to be putting money back into like their core businesses, or at least that's what they say they're going to do. So I'm just curious
Yeah.
what you think about how their last quarter or their quarter that they just reported was, because this is what we've talked about a lot and there's been a lot of change.
So this is typical me. I haven't really dug into the results that came out last week, I guess.
Yeah, a week or maybe a week and a half ago.
Yeah. Yeah. It's been less than 2 weeks ago. It'll be a couple weeks when this episode comes out, but I haven't really dug in. Like I went through and like I looked at each of the three business units they have, the surety insurance, the billboards, and the broadband. I looked at those and the latest update because they're still in the process of exiting all the investments in the asset management business and returning all of the funds back to the investors. So that's still playing out a little bit. But I do think that consistently what I'm continuing to see is the thing that worried me from the beginning. It's funny because we talk about how usually these executives they suck at capital allocation. I think Alex Rozak, is that right? Alex Rozak was actually good at capital allocation. And maybe Adam Peterson, I'm sure he was part of it. So I don't want to give him short shrift for that too. But they were good at the external stuff. Dreamfinder Homes, I can never remember the name of it. The
Sky Harbor.
Sky Harbor. There were a couple other things that they did that those were really profitable investments for them. Really, really profitable investments there's been a lot of focus on the fact that it still trades at a big discount to book value. And what I've continued to say is the discount to book value is not that far from the amount of goodwill they have on their books. And my biggest concern is that the internal acquisitions they've made, not the investments they've made, but wholly owned acquisitions, buying billboards, buying insurance companies to bring under the same insurance brand, which I think they just combined it under one insurance brand this year. That's where all the goodwill is. And the operating results continue to be very underwhelming. And that makes me feel more and more like where they were bad at allocating was the assets that they've acquired that they're keeping internally. Now, caveat, they're still spending a lot of money to expand the broadband business ahead of customer acquisition and getting those assets to where they're stable, generating cash flow, and those should be really high margin as they stabilize. The jury's still out
Mhm.
on that, but I continue to just be very underwhelmed.
Yeah, underwhelmed is the perfect word for it. It's like every quarter I feel like for the past year plus, I look at the results, I think about them and I say to myself, good enough to not compel me to sell, but not exciting enough to have it be like a high conviction idea or even add more to my position. And
Yeah.
I I think that's like the most frustrating place to be. And I understand why, maybe you and I both would have been better off to like the first or second quarter we saw that been like, forget it, I'm out. Like this isn't worth my time and effort. But I don't know. There's something about it that I'm still kind of interested to see how it plays out. I mean, here's what I'll say. The
I will, you know what? Let me say this real quick and then you can have the last word on it. At this point, the only reason I own it is because I do think it's interesting.
Yeah, I think I'm in the same boat. I mean, so for the last 1, 2, 3, 4, 5 quarters, right? Revenue growth's been okay. 15-ish, 12, 15-ish% with the exception of one quarter where it dipped to 9. Now before that, it was in the 40, 50% range, right? So tough comparison, but I don't know, mid-teens revenue growth is not awful. That's not a business that is struggling on the top line. Profitability's been a hot mess. Cash generation's been a hot mess. But, you know, the two biggest revenue drivers, broadband and billboards, have been growing decently. 2 years ago, the broadband business was still newish. It was only 25% of revenue. Billboards was 56%, and now it's 36% for broadband and 42% for billboards. So
Yeah.
it seems like by the trajectory that the broadband business is actually going to be bigger than the billboard business in not too long from now, and that's higher margin. And um, so that's part of what's interesting to me. Like kind of seeing 2 years from now, is this more of a broadband play than a billboard play? And I don't know. Like I do wonder if they're done buying different things, right? So like maybe
I
the
think for now
asset.
they have to be.
Agreed, but I'm saying like let's say we hold this for the next 5 years. Is it still just billboards, broadband, and insurance,
If I still
and
own this
and
in
some
5 years,
minority and some minority investments, or did they
yeah,
do something more interesting than that? That's kind of what I'm waiting to see.
I would say that the vast majority of investors that own this stock right now, if they still own it in 5 years, it's going to be because they've actually been good at what they're doing, regain credibility, and earn permission from investors to go find the next thing that they wanna
Hmm.
they wanna grow into. I think the probability is very low of that happening, though.
Yeah, I think I agree with you. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part? If you act now, you can potentially lock in a 6.9% yield until 2028. The new bond account, only at public.com/investing unscripted.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as NVDA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
where do you want to go next? You created a list.
So I want to talk about housing and home builders a little bit because
Oh,
it's
I want to
such
do
a
that too.
it's such a big part of the market, like the economy broadly. Housing is such a hot button issue. We're in an election year, so we're going to constantly be hearing about affordable housing. And let's be honest, if we look broadly at a lot of home builder stocks, they've continued to rip. They've done really, really well. Even as like we've seen revenues come down a little bit, margins have come down a little bit, but if it feels like they've adapted to the new playbook of higher interest rates, and there's still so much pent up demand because there's no inventory of existing homes for sale. It seems like that's picked up a little, but I want to kind of talk through, you know, where do you think when you think about the home builders market, you think about investing in that space, you think about housing as an investor, kind of how are you thinking about it?
All right, I own a home builder, and you tease me constantly that it's the worst of them, but whatever. We're not going to go down that road right now. I guess what I think about is I think it kind of
Oh, we
depends
will go
when.
down it. I'm kidding. We won't.
I
We won't.
think it depends when you buy home builders. Like, so here's one of the things I'm worried about.
Absolutely agree. That
I
is
have
absolutely right.
I have not looked at the valuation of the home builders writ large, but let's just assume right now that they're on the higher end of the valuation scale simply because of what you just said. They've been ripping, they've been doing well. And I do wonder if they cut interest rates in September, and let's say, who knows, maybe it's more than 25 basis points. Maybe they cut by 50, or maybe they do a 25 in September and a 25 in December. But let's just say a year from now, interest rates are somewhere between 25 basis points and 100 basis points lower, right? Just to pick a random range. And you bought a basket of home builders today. I do wonder if that loosens the market up enough to take enough pressure off of the new home demand to have those stocks underperform today's valuations. Does that make sense?
I'm gonna throw some. I'm not gonna throw the exact numbers out here, but like this is the for me this is the conundrum with home builders. We've talked about this before. When we've talked about valuation. Can't remember which episode it was that we did, but talking about how with cyclical stocks, especially, they can look expensive when they're cheap, and they can look cheap when they're expensive. And as much as home builders, like the secular trend is still, I think, very, very good because we're still substantially underbuilt. You have to be thoughtful about and mindful of investing across the cycles. But I can tell you, like if you look broadly, I'm just pulling it up just so I've got it for a frame of reference, but looking at like, so here's the big builders, DR Horton, Lennar, Pulte Group. Those are some of the biggest builders. I'm not going to bring in NVR because what they do is a little bit, they're a big builder, but they've got the mix with the financing and their business model is a little different. Stocks for all of those, like every single one of them is at or near all-time highs. Like you look at them and you think you're looking at like tech stocks, how much they've gone up over the past 10 years.
Right. Well, that's what I'm getting at. This goes to what we were saying earlier. Like if you buy
Yep.
them now and over the
Yep.
next 2 years, they continue to do well, but not priced to perfection well because interest rates came down and now people are willing to move. And now there's a lot more houses on the market. And now there's less, pressure on new home building.
Yeah. Yep.
Is an investment from today a higher likelihood of, being a bad decision for the investor? That's what I worry about right now.
From a valuation perspective.
Yeah.
From a valuation perspective, you look at price, and this is trailing price to earnings. You can look at their forward estimate, the multiple based on that too. Meritage Homes, Green Brick Homes, Horton, Pulte Group, Lennar. So this is a mix of the biggest and some that are still pretty big, but really are more focused on like entry level. It's like really the sweet spot of where the demand is. From a multiple value, every single one of these is cheaper than they were in 2017, 2016, 2017.
Hmm.
Every one of them. Like even with a massive drop in PE ratio as their earnings skyrocketed over the past few years, stocks did well, but their earnings went up even more. Like even factoring in like those ultra low multiples, they're still every one of these is below their 10-year average price to earnings multiple.
Interesting.
Every single one of them.
Wow.
And they're all bigger than they were because there has been so much demand. The answer to that question, so I'm going to repeat your question. Your question was, if we see interest rates drop, we see existing inventory start to open up more, and you can say one of two things: take pressure off of home builders, or you can say take away from the opportunity. What are the stocks going to do? And my response is, since the beginning of the year, existing inventory of homes for sale, according to National Association of Realtors data, has increased from less than a million to 1.3 million. So we've seen a 30%, essentially, call it a 35% increase just since the beginning of the year. Back in 2016, it was over 2 million. It should consistently be between 2 and 2.5 million in a healthy market based on household formation, the available inventory, relocation rates, like all of those things. We're still, call it half, a little more than half of the amount of inventory that we should have in existing homes for sale to meet that part of the market, which is like 80 to 90% of the market. We would need to see a massive increase in supply to reduce the demand. And the other thing too is that housing is local. It's where the inventory is, and looking at migration patterns, like in the Sun Belt, there's just not enough existing inventory in those markets.
Well, all right. So that brings up a question I've been wondering, right? So the home builder that I own is Dreamfinder Homes, which is smaller than a lot of the ones you just mentioned.
Yep.
You can debate whether their asset light model is really asset light, considering they have
So
a lot
they're
more.
land light, but they're debt heavy.
Yes, that I was just going to say that. But they build starter homes and second homes in Sunbelt like communities,
Yeah.
right?
Oh no, they're in the right
So
markets.
they're in
No
the
doubt
right
about it.
places and they're selling the right types of homes. So
I
that's
own some
my
Dreamfinder too,
I
right?
know
I
you do.
just like giving you crap about it.
But here's what I wonder though. In a world, I understand your point about even if interest rates drop to 1%, there's still a shortage of homes, right? Like even if
Right.
everyone wants to start to move, we still don't have enough.
It's math. We don't have enough houses of
Right.
the right size and price in the markets where people want to buy them.
But here's what I wonder, and this is my question to you as someone who knows this space a lot better than I do. Do the larger home builders have a substantial competitive advantage by virtue of their size? For two reasons. I would imagine a larger company, a larger home builder can be in more places at once and building in more places at once. And I would imagine they get better prices on commodities, right? If they're buying wood and nails and shingles and all that kind of stuff, they can buy it in bulk and get better prices. Are they competitively advantaged to a significant degree to a smaller company like Dreamfinder Homes?
Yes and no. In some ways they are. One way they are is that they have more relationships. They're connected to more of the supply of land. They can acquire more land. And as much as like the options model that we talked about with NVR and that Dreamfinder, like that they're using, again, the way that for anybody that doesn't understand, if you're a home builder, you need land to build and you need to plan well in advance. Historically, you've had two ways to go about it. Most of the time, it was just you bought the land. You bought the land and you try to buy it from a land developer, so it's already got streets and sewer and like the infrastructure is already in place. Or you buy it and there's a plan to have that infrastructure in by the time you're ready to start construction in that market, right? The other way to do it is you have an option where it's just like options for stocks, where you pay a premium and you hold an option to buy the land. It's by some date at a certain price. NVR kind of led with that innovation because they had to. Coming out of bankruptcy in the 90s, they cost of capital was really high for them, so they had to get creative. So they got a bunch of developers to agree to take an option with them. So they've kind of led with that model. Dreamfinders, like they really market that they use that a lot in their investment material. Meritage uses it too. I think when they were kind of at the peak of it, like 70% of their land was through options. It's been less because there's so much more competition now for land. There's a little bit of advantage for some for some home builders that they can just buy the land and they're willing to buy the land, right? So that's where scale has advantages because you just have more access to capital, right? I don't know that any of these builders are getting significant better pricing on raw materials. The other aspect of it for the bigger builders is most of the labor is contracted labor, right? They don't have carpenters on payroll. They just have larger pools of contract labor because they're generally more guaranteed work, right, than some of the smaller builders. So that's another advantage that they can have as well. So I think the biggest thing is cost of capital is an advantage for the bigger builders.
Yeah.
Whether
Yeah.
whether you're using options or you're buying land and borrowing to do it, cost of capital is just cheaper.
Yeah. I've thought about buying more home builders just to, because I agree with what you said. I think it's you and I have talked a lot about investing in trends and finding
Mhm.
things that are going to have secular tailwinds behind them for a while. And it does seem like home building has to be. We need more homes, just like we've talked about cybersecurity and things like that being, you know, areas of the market where we're just going to need more of that moving forward. I don't know. They don't interest me that much. I've had a
No,
hard time.
I completely get that. I do, and I will say that as much as I spent a lot of years pounding the table on this trend and, like, really trying to be mindful about the cycles and investing and the timing, Meritage Homes has done really well for me. It's almost 4% of my portfolio, and I've continued to buy a little bit here and there, and I have a few other that have done really well for me, but it's not like 25% of my portfolio is in home builders as much as, like, I clearly saw everything that's happened directionally. Obviously, interest rates crashing and then skyrocketing, I never saw that. But, like, directionally, the clear supply demand aspect of it and that opportunity has absolutely played out based on what I expected. But I have really still struggled, like, looking at the multiples now versus the actual stock price and the actual big earnings dollars amount and thinking about how is this gonna really play out over the next 2 to 3 to 5 years. I do think that broadly, if your time horizon for these is 5 plus years, I think even these prices are still gonna work out very well. There's just still so many houses that are gonna need to get built.
All right. I want to end our Investing Unscripted episode with an unscripted question for you. So, if I were a successful investor with a decade track record of beating the market,
So if you were me is what you're I'm sorry.
so if I were that person, much like someone who is not on this podcast, um, why I don't think I'd be the kind of person who would just constantly crap on younger, newer investors and the decisions they make and the companies they like, especially when said younger, newer investors maybe it might be a decade or two before they're proven wrong, or maybe they're just learning, maybe they're just at the beginning of their journey. So I'm curious, as someone who's at least older than me and doing this longer than I have, why
Those
do
are
you
the
think
2
that is?
things about me that are true.
Why do you think it is that some people feel the need to like constantly denigrate other investors? It's a piece of investing psychology that I find fascinating.
You know, I've actually thought about this too, and I guess the better answer to that is maybe instead of trying to think about why other people act the way that they do or take that approach is this is a hard game, right? It's hard. If you're gonna pick stocks, it's very difficult. And once you figure out something that works for you, especially if it's a very discipline specific approach, sometimes it can get really hard to see, especially if you've invested in other ways that have not worked out for you. You see other people taking different approaches that look like failure to not just have a very visceral reaction to that, right? So I think that's a big part of it. And it can also just be hard to once you know like once you know what works for you, it can be just Jesus, people, it's just do this. That it works. This works. Just do this. Stop. You're stupid. Stop doing this other stupid thing. Right? You're smart. Be smart. I'm right. Just follow me. Maybe there's Schadenfreude too. I don't. I don't know. But if
Yeah.
there's any one thing I've learned, so again, let's make this about me. It's a lot more fun when it's about me, Jeff. There's a lot of ways to be successful in this. Peter Lynch bought thousands of stocks, which is interesting because the words that you wrote last weekend talked about how the evidence is actually pretty overwhelming that for individual investors, having a more concentrated portfolio generally generates better returns, right? Than being too diversified. Peter Lynch blew all that conventional wisdom out the window. There was one Peter Lynch though, right?
Yeah.
Don't try to be Peter Lynch, I think maybe is the answer there.
Well, all right, wait, hold on. But I hear what you're saying. I don't mean to cut you off, but I'm going to anyway.
It's the
I
right
guess
thing to
what
do.
I guess what I'm saying is this, and I'm going to give you a compliment here, right? So you push back on things that I want to do all the time.
You
And
have some really dumb ideas.
I fair enough. I'm not saying I don't. My portfolio of shame that I keep track of all my sold investments would indicate that. But what I appreciate is you stop short of like mockery right?
Yeah.
And it's more like, here's something I learned, here's something to think about. But in the end, you're like, all right, man, you got to go do you. And I just, like on Twitter and out there in the world, there's so much not that. And I don't know, maybe it's just the teacher in me, like
Yeah.
you got to find a way to encourage and help people who haven't been through what you have yet in a way that doesn't,
Right.
like crap all over them, that I don't get it. Like if I were Peter Lynch or someone of that caliber and some newer investor was like really excited about some idea, I would, I might be like, well, I wouldn't do that. Here's why, something to think about. Here's a risk, but I wouldn't just call it a shitco and mock the person. So
There's a ton of that on social, right? You see that. And I think a lot of people because of the incentives of social media, especially for FinTwit, there's positive feedback to that, right? You can grow a following when you dunk on other people. So I think that's part of it. I want to circle back to Buffett a little bit because I will say my favorite thing about Warren Buffett is that he's written thousands and thousands of words about his mistakes. He has gone into painful detail about mistakes far more than he's gone into detail about individual investing successes. And I think the most valuable thing that any successful investor can do to help investors that are investing in shitcos is not tell them they're investing in shitcos, is to tell them about the time that they invested in a shitco, right?
yeah,
That's how you help people do better.
agreed. It's a good place to leave it.
We'll leave it there. All right, Jeff, we'll wrap up this unscripted episode with our relatively scripted ending.
Before you do it,
Yeah.
I want to just real quick, if anyone enjoyed this, if you thought this completely unscripted episode was enjoyable, if it had a different vibe and you liked it, let us know. Give us some feedback, either email, social media, give us a review. The review has to be 5 stars, but you can say something critical in it.
That's a
But
good rule. That's a good rule.
tell us how terrible
we
we are
take-
with your 5-star review.
We take critical feedback with 5-star reviews only.
That's right.
Yeah.
If you really want your feedback heard, please accompany it with 5 stars.
Yes. Yes. No, yeah, please. In Spotify, you can comment, ask questions there, give us feedback there. Email us at investingunscripted@gmail.com. All the ways you can reach out to us, it's pretty easy. Asynchronous communication is the best. Use it. All right. Time to give the scripted ending, Jeff, to the unscripted Investing Unscripted show. As always, Jeff and I love to give our answers to these hard investing questions. But you know what? They remain our answers. Try them on, see if they fit, but you got to walk around in them long enough to make them your own answers. And you know what? Do it even better. Find your own answers to these questions. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.